Picture the flow of capital as a raging river. Who can predict which way the tide will turn and when? Elsewhere in the Bavarian capital Munich, economists study the international flow of capital. They've made a science of riding the peaks and valleys.
Every year, industrialized countries pump about 1 trillion euros into emerging economies, most of it as fixed asset investments, development aid and so on. That's long term, but some of that, nobody knows exactly how much, is short term. And the short term capital can be pulled out again at any time. It's meant to profit from the higher interest rates, and it's highly volatile.
Volatility means higher highs and lower lows. For investors, it means the higher the waves they surf, the greater the risk of getting wiped out. Global investment company PIMCO manages capital for private investors. Sometimes they invest in emerging markets. The fund manager admits he was not expecting a correction as big as what came last week.
Did we anticipate the move in treasury yields and in currencies and rates that we saw then in emerging markets? No, we didn't anticipate the extent of the move, but we were taking out some of that exposure based on the fact that valuations were very rich.
Essentially, what happened was that the U.S. Federal Reserve Bank put the brakes on its monetary policy, cutting back on its bond buying from emerging markets. And that made the market as a whole more cautious.
This is a graph on the Turkish lira, and basically what you see is that after the financial crisis, the Turkish lira was pretty well. There was a lot of demand for emerging market assets. The Turkish lira did very well. Here is when the Fed introduced the possibility of removing some of the accommodation in the market. So we see the first hit on the Turkish lira, and then it stabilized a little bit, and then we had some political problems in Turkey, and then the Turkish lira took another leg down, right? So what you see here is, different legs down on the currency.
The Turkish lira is still under intense pressure. In London, the capital flows especially fast, wide, and deep. The multinational investment corporation BlackRock is the world's largest asset manager, with more capital under its control than Germany's entire annual gross domestic product.
BlackRock manages $4.3 trillion globally. I head the emerging market specialist team, which is one of several teams in BlackRock that looks at emerging market equities, and we manage many billions of dollars in emerging markets.
But of course he won't say which ones they're looking at, only that the emerging economies' central banks generally responded correctly.
We've seen a range of central banks increase interest rates, whether that's in Turkey, South Africa, India, Indonesia, Brazil. Across the world, we've seen central banks in emerging markets raising interest rates. That's not good for growth in the short term, but it's very important in terms of sending a signal to the market that, number one, these currencies won't fall forever, and two, to attract the capital that's needed to finance some of these current account deficits.
The fund manager says the situation isn't bad at all for investors right now. When calculating possible investment returns, the Munich economists have to factor in the risks coming from the global economy.
Of course, a shock anywhere in the world can spread rapidly, sometimes even irrationally, as we saw with the Lehman bankruptcy and other effects, where at first we thought they'd be limited. So you have to be extremely careful.
As with surfing, it takes a fine sense of balance to stay on top of a fickle investment market.